Hi, welcome to the 5th of March episode of the Part-Time Show. I'm Dr. Kapil Amrasinghe, and today I'm going to talk about liquidity. Now I'm really prepared this, I sort of prepared this, but I need to keep it quick. I want to keep it within 10 minutes if possible. It's an idea that's been running around my head for a long time. It's something that if you're going to study Bitcoin or currency or any kind of investment hypothesis, you ultimately have to understand. I'm not going to explain it to you directly. I'm going to explain it to you indirectly using an analogy, a thought experiment that I hope you guys will value. Let's start with a society of 100 people, and let's say they're actively trading with each other and the wealth's flowing around. Some people have a little bit less than others, some people have a bit more than others, but they're all using the same instrument to trade with, let's call it the British pound on an island. We'll call it the cap pound, in fact. So everyone's trading. Everything's great. But one day, all of those cap pounds get accumulated into the hands of one person. So in this village of 100 people on an island cut off from the rest of the world that's completely self-sufficient, there are 100 people, they're trading in currency, and eventually 80% of all the pounds in circulation are now in the hands of one person. And this person, for whatever reason, he says, screw this, I am not going to spend any of my cap pounds that I've earned, even though I hold 80% of the world's cap pounds, of the island's cap pounds. I'm just going to lock them up in a bank somewhere, or and live off the interest, as it were. Now, I'm going to assume this is a non-inflational currency, so you can't issue any more. So now we're in this really interesting situation where, 20% of that island's wealth is now held by 99 people, and 80% is held by this one guy, right? And this one guy's refusing to spend any of that wealth. So then what happens? Suddenly that whole island has just lost its spending power because that wealth is kind of locked away. It's out of circulate. That the definition of value, that thing that we've given value to. I emphasize that thing we've given value to. The vast majority of it is now in a fort somewhere, untouchable. And everyone else only has a tiny amount left to, build roads with, maintain the schools, keep the waterworks running, keep the heating and the electric on, make sure the shops are stocked, make sure the medicine supply cabinets are all filled up, make sure everyone's essentially alive, happy, healthy and well. Has this currency that's non-inflational and essentially been accumulated, has it lost value or has it gained value? I would argue it's lost value, because the whole point of currency, of a unit of value, is to be actively exchanged, actively spent, actively used in the buying and selling of goods and services. So when your currency is not actively doing that, or when the vast majority of your circulating supply of that currency is not doing that, then I would argue that that currency is overvalued relative to other currencies that are being actively used for the buying and selling of goods. So here's the thing, this is why I've been going on about this. With liquidity, I feel modern Western economists have made a mistake. They've taken a misguided approach. In the 2007 and 8 financial crash, the world's economy almost collapsed. You can go study it if you don't know how or why. I think that's pretty important pre-reading. Or just watch The Big Short. It's a great film. It explains it really well. But then read up on it. Anyway, the response of multiple Western governments on the advice of their economic advisors was to lower interest rates and to print off more money. The lower interest rates were designed to stimulate lending, which then would facilitate the creation of new businesses, startups, help existing businesses grow, expand, helps save other ones that maybe not doing so well. And the purpose of printing off money was, that money that was being printed off in something called quantitative easing, it was essentially being used to purchase bonds and stocks, a lot of that money. And that was driving up the price of shares, which was encouraging participation in the stock markets, essentially stimulating a period of growth. And it worked great, as in the stock markets did fantastically. If 2007 and 8 was 2008, 2009 was the best time to buy shares. If you look at any general indices, after the crash, if you put your money into a tracker, you've gotten good growth. The unfortunate thing is the vast majority of people didn't, because the vast majority of people don't understand a clue about stocks and shares. They don't understand anything basic about finance. Most people leave that to the capable hands of others, and that's been really unfortunate because this is how a lot of the modern problems we've seen from that arose, and this relates right back to what I've been talking about, liquidity. The problem with using artificially printed off money and then using it to prop up a stock market is that, yes, the price of stocks and shares for various companies on average goes up, but that doesn't really mean the employees who work for those companies are necessarily any better off. It doesn't mean they are guaranteed better standards of living. It doesn't mean they're guaranteed better wages. It doesn't mean their local communities do better. It doesn't even mean that the companies that are benefiting from this have to upgrade their infrastructure or their services. There's lots of things you can do to just push up the price of stocks, such as just buying up your own shares. A lot of this stuff's actually illegal. Some of it's illegal, but some of it's quite legal. What I'm basically trying to say is all of this money was created out of thin air, but not a lot of it necessarily went into the employees, as people who believe in the trickle down effect would tell you. So there's already been a lot of wealth creation. It's just a lot of that wealth that's being created is being concentrated into the hands of a minority who happen to be investing wisely in stocks, shares and bonds. And kudos to them. But here's the rub. A lot of the money that was printed off, it wasn't just that. There were a lot of cuts made by governments to help bail out certain banks, and to fund those bailouts, a lot of funding to social public services had to be cut. And I understand why the economy would have collapsed, as in the stock markets would have collapsed, banking would have collapsed, lending would have collapsed. All the traditional financial structures that are built up over time would have collapsed if these things hadn't been done. I get that, but the real problem with this is this, and I think if I highlight it this way, it makes a lot of sense. Most private companies are, they're shareholder driven, right? So a company, let's create company X. It can have 1,000 shares, and the way the modern structure for shareholding works is that, of those 1,000 shares for company X, not a single one of them necessarily even needs to be held by an employee of the company, apart from, no, not necessarily. The vast majority doesn't need to be held by employees. In fact, the vast majority of those stocks may be held by private shareholders who aren't employees for that company, who are not related to that company in any way. Yes, they want the company to succeed because then their share price will go up, but actually, really, they want their share price to go up. So they don't care how the company succeeds. And this is the innate problem. I believe a lot of the economic theory that drove the concept of quantitative easing and helicopter money and all the measures they took from 2007 and 8 to save the world economy. I think it was well intentioned, and I think it could have worked, but I think it could have worked a lot better in a world where the shares of a company, where there was better distribution of the shares issued by a company into the hands of its employees. So here's the thought experiment. And this is another one of those how does it make you feel theories questions. What if we lived in a world where by default at any given point, any corporation that issued shares that ran on this structure, what if by constitutional law and international agreement globally, any private company, 50% of its shares would always have to be held by its employees at any given time. And if an employee left the company, then those shares would get converted to private shares, but then the company would have to issue out more shares to be distributed amongst its employees to maintain that 50% balance at all time. That's the thought that I want you to consider. Why am I coming up with this? It's this. If I believe if private corporations were forced to do this, then a lot of their decision making from higher up would be a lot more reflective of the well-being and interests of their employees, which in turn would be a lot more reflective of the well-being and interests of societies. I think you would see a distribution of decision making to be much more reflective of the majority of people. Because the majority of people, a good chunk of people globally work for private corporations, but they don't have any say in how those corporations are run. The shareholders have a say. Whereas if you, by law, made it so that the employees of a company combined had 50% voting power, suddenly a lot of things that most people who work day-to-day jobs find questionable, suddenly the board of directors, the guys who make the executive decisions of the company, they're now going to have to answer to their employees more. And I think then you'd have an incentive structure in place that favors better living standards, that actually enables the trickle-down effect to truly flow through. Then I don't think the cuts to public services and health and social care, etc., that happened in the UK, certainly, I don't think they would have had as much impact, purely because I think employees would have had better salaries, better sick pay, better working conditions. They'd have more spending money to then go out and spend things. If you look at real wages versus inflation over the last 10 years, for the vast majority of people, real wages after inflation haven't really kept up with inflation. Real wages have been going down. If you cut all the underlying maths, they've been either stagnant or going down relative to currency inflation. That means, the vast majority of people have been getting less of the global circulating supply to spend and play around with, whereas a minority is accumulating more and more and more. And this goes right back to what I was saying about liquidity. All of these measures, because you've not dealt with the fundamental problem of how modern corporations are run, has effectively created a liquidity restriction. And this has effectively meant that we got that scenario with the island with 100 people, and one guy suddenly got 80% of the world of that island's wealth and is refusing to spend it or distribute it around or spend it on the employees or whatever. He will spend it for himself or he'll hoard it, and that's great. But now let's pretend it's no longer an island of 100 people. Let's pretend it's an island of 1,000 people. Right, and the one guy holds 80% of the wealth. Are you seeing something here? Because I am. Now let's say it's an island of 10,000 people. Because, you know, in an island of 100 people, I guess there's a bit more social pressure. All the people know who he is. The target on his back's a bit bigger. He's going to bump into people. They're not going to be particularly pleased. So he might play a bit better. And he's also got time, you know, if he's a genuinely decent human being, and by far the vast majority of wealth holders are. You know, they have time to listen to people. It's just they only have so much time in a day. You know, if you're awake for 16 or 18 hours, then if you're holding a 10-minute conversation, you can only chat to, there's only a finite number of people you can chat to in a day and take on board. And the less time you have for someone, the less you're able to sometimes gauge what it is they need and figure out what works for them. So if I was accumulating more and more and more wealth, and suddenly I held 80% of the world's wealth, shit. Even if I wanted to look out for everyone, even if I was a decent guy, divide 16 hours into 10-minute segments. There's a finite number of people I can listen to, and there's only a finite number of ways I can distribute money and the finite number of ways I can think about things. Realistically, in a given day, I can deal with 20, 30 people if I'm fairly busy. Well, not more than that actually, but you know, if you count patients, see about 30 a day, and if you count colleagues, another 30, 40. Okay, so yeah, you can see a few, but you don't get to know people with that. And there you go. That's what I'm getting at. Now let's scale this up and say 1% of the population holds over 50% of the world's wealth. I would say we have a very significant liquidity restriction, and I would say our currencies as they stand are probably overvalued compared to what they were 10 years ago. And I think the measures we've put in place to try and mitigate that have worked on a superficial level, but they've not really worked on a deeper level. And to be honest, you know, in my job, you can see that. I've seen how things have changed in the last 5-6 years. Certainly, it's really obvious. And you know, they have been changing over the last 10 years, but they're much more apparent to me now.